Hey everyone, this is Michael Lee. I'm the founder of the Data Incubator. Welcome so much to our the latest installment of Data Science in 30 Minutes, our live online webinar. So I'll say a few words about who we are at the Data Incubator and what we're doing before I turn it over to Jess, our wonderful speaker for today. So the Data Incubator, we run a fellowship for PhDs and master's students looking to enter industry as data scientists. The program is completely free for the fellows who get in, and you can apply online at thedataincubator.com. We also offer online courses for working professionals, and you can sign up today for our foundations course. And this will be, and tomorrow, actually, September 28th, will be the last time to join the course for 2018. So you can sign up for that also at thedataincubator.com. And finally, we also offer corporate training and hiring. So we help companies who want to hire data scientists or train them up. And if you're interested, you can also find out more information about that on our website. So today we're here to do another installment of Data Science in 30 Minutes. This is a regular monthly series on data and its role in the world. And so previous speakers have included Kirk Bourne, who is the Director of Data Science at Booz Allen Hamilton, Becky Tucker, a data scientist at Netflix, Holden Corral, an engineering lead at IBM and one of the core contributors to Apache Spark, Andreas Moeller, one of the creators of scikit-learn, Sam Swift, the VP of Data Science at Betterment, and also a former fellow at the Data Incubator. And of course, today's speaker, Jess Stauth. So I'm really excited to have her. She's the VP of Data at Quantopian. And actually, before I begin, I should really say that if you're interested in posing questions for our speaker, you can do that on the YouTube chat area. In order to do so, you'll have to be logged in. So you will have to do that. We'll be monitoring that, and we'll be asking the speaker the questions from YouTube that you are posing from YouTube throughout the segment. So without further ado, let me introduce today's speaker. So Jess is the investment managing director at Quantopian, which is a crowdsourced quantitative investment firm. Really cool company. It inspires young, talented people from around the world to write investment algorithms. And then Jess and her team go and select these algorithms and deploy actual capital, that is real money, behind these strategies. Quantopian offers a licensing agreement for all the algorithms that fit within the investment strategy, and the license authors are actually paid based on how well the algorithms perform. So without further ado, Jess.
Thank you, Michael. It's nice to be back. I think you and I chatted maybe 2 years ago or something at this point now.
That's right. And what's changed at Quantopian since then?
Great question. So yeah, I think it probably was about 2 years ago that we spoke last. So first of all, thank you so much for the introduction and for having me on your webinar, your podcast, whatever is the right lingo for this. It's cool, and I'm excited to be back and chat with you. So yeah, the last 2 years have been fascinating and really exciting time to be at Quantopian. So your introduction was great. That's exactly what we are. We're an online platform where anyone with access to the internet can learn about quantitative finance, learn about data. We have a research platform and a backtesting platform. They can learn about how to write quantitative investment strategies. And then my team looks through those investment strategies results. We don't look at your sort of secret sauce, but we run our own backtest. We look at your investment strategies results, and we try to separate the wheat from the chaff. And we're looking for the best strategies to back with investor capital. And then you get a cut of basically a royalty agreement. So what's changed is, you take something from a concept to reality. So about a year, I guess, and a half or so ago, we took our sort of prototype portfolio of algorithms we had picked from the community. We had sort of gotten this project bootstrapped and started off with investing what's called proprietary trading capital, which means you take your own capital and you trade it in the market. And we had done that at small scale. And about a year and a half ago, we actually launched a hedge fund around the business, and we launched, investor capital. So we took the scale, from sort of a small prototype to and in the industry, it's always interesting what folks think is a small amount of money or a lot of money. But we launched our fund, and we currently have, just over $150 million in trading capital allocated out to members of the Quantopian community. So for folks who are not traditionally in this space, there's not a ton of algorithms in that pool at this point. We've been extremely selective kind of by design up until this point. So, for folks who are coming new to this space, that's a lot of trading capital to have access to. And it means that if their strategy performs well, their share of the payout can be good. So, really what's changed in the last year is just sort of seeing how those algorithms have scaled with capital and seeing which ones have done well, which ones have underperformed our expectations, what our portfolio looks like, and sort of what we need more of to scale it out to the next level. And that's what have been super excited about. We've made a ton of progress over this summer, looking at really trying to understand where we have pretty good coverage. So for example, I'm going to talk today about sort of some common pitfalls we've learned from real world examples of algos, but we've seen kind of where we have a lot of coverage, which, sort of signals people have gotten out of price and volume data. And we're learning about where we want more signals, which I'll talk a little bit about coming out of like fundamental data sources or alternative data sources. So that's just been really interesting and, amazing to sort of get a front row seat and also, try to be part of making that product work. At scale and at real scale capital. So that's kind of what I wanted to talk about today when you guys reached out and said like, hey, what have you learned about data science in the last 2 years? I sort of felt like what I learned was kind of seeing data science go from, backtest land or laboratory land into, in my space, the real world is the stock market.
Yeah.
So that's kind of what I thought we would chat about today.
Absolutely. And just before we begin, how many algorithms do you have running currently?
So I think there are 7 that are trading live today. Now, one thing we've worked on a lot this year, we sort of saw what was working, saw what we wanted to improve on. And so we sort of took a pause from adding strategies and focused on sort of a little bit of a retooled combination like methodology, which is sort of not quite ready for prime time for me to quite explain and talk that much about today, but suffice it to say it's sort of actually more data science-ifying sort of our part of the value chain and kind of putting a little bit more into the combination logic and the way that we combine signals together from the community. And what's exciting about that is we're looking at trying to get that sort of combination approach into our portfolio by the end of this year. What I think will happen is our goal is to sort of go from 7 licensed algos and really ratchet that number up substantially. But we just sort of needed to, kind of, and the other thing I think, I don't talk about this in the common pitfalls, but you sort of see in the real world, right, that the stock market, sort of unspools, 390 minutes a day and, 252 days a year. And you want to sort of be learning, but not be like actively changing every single thing you're doing in the market at every minute. I'm sure that's clear to you. And so we sort of felt like that was the right approach to sort of let this portfolio that we had a good amount of confidence in, though it was sort of, at sort of one size, kind of season and see how that was going while we were sort of working on, okay, here's the thing we think we can put in place to scale it. So that's where we are. So we're looking right now at, probably a couple dozen signals that are sort of in late stages of what I would call diligence. And so I think we're going to have a step change, hopefully by the end of the year, where we see that number jump up, pretty substantially and then grow from there. We would like to be able to, work we're doing now is sort of designed to unlock being able to add much more quickly and at scale.
Oh, okay. So you're hoping to go from just 7 today to potentially 20 or something like this?
Yeah, that's what we're hoping, like 20 to 30 by the end of the year. And then, I don't know. It's interesting to say, like, what's the right logical upper limit? I think it depends a lot on how folks decide to continue building strategies. So you can find strategies where they're very modular, and you can find strategies where they have a lot of breadth. And I'm going to talk about that actually. And so, strategy is not a one size fits all. And so I think it depends sort of what are the signals that we put together, whether we end up with, dozens, hundreds, or thousands. I think it may become a little bit semantic. I think we're going to certainly be having, I would hope, in the high dozens to hundreds of people with licensed intellectual property in the fund, by the end of next year.
Got it. So I would really, yeah. So what I know you have some slides about this. So why don't we begin?
Yeah, perfect. So let me share my screen here. And you can let me know when you can see this all right.
Seems to be coming up. Perfect.
Okay, great. Yeah, so what I wanted to talk about was, there are these like incredibly, sort of, if you have experience in the field, these incredibly common pitfalls to building stock market models. And what I see that is, sort of both great but also frustrating is this, real uptick in data scientists coming into the field, which it's very exciting. And I think they can bring a ton of new techniques. On the other hand, you hate to see them sort of repeat common mistakes that are avoidable. And I feel like I have seen that. It's not only data scientists are guilty of it. Anyone who's coming into the field, might be guilty of it, who's coming in sort of without a lot of domain experience. But I think for data scientists, it can be particularly painful because they might have, very sophisticated techniques and a very deep amount of experience in sort of another field. And they come into the stock market and there's just these like kind of basic tenants. So I wanted to kind of talk about how to avoid those. So also, folks can feel free to get a hold of me directly if they have questions, that we don't get to during the webinar. So in the interest of time, I've sort of picked what I think are the, I guess the first two are the worst offenders. So I say selected common pitfalls, overfitting and overtrading. Also bad are sort of thinking or not thinking about regime changes and whether the processes you're modeling are stationary or not. And then finally, look ahead or what I'm calling time travel illusion. So I'm going to sort of try to step through those. But please interrupt me, Michael, with questions, either from folks who are watching, or yourself, because I really sort of, put just a few examples together, but I'm happy to kind of talk about more flavors of each of these problems.
Got it. Got it.
So people talk a lot about overfitting, and that's probably like, I would say maybe the best understood failure mode for data scientists coming in, right? They understand, and I think I might have like an XKCD slide at the end of this, right, where data scientists understand what overfitting is. So I thought, okay, well, let me not like lecture you folks on what overfitting is, but let me show a really tangible and maybe not like super intuitive example of how in stock market modeling, you might back into overfitting. So this is a real world example. And what I'm showing here in this little table is 4 different strategies that came from a single author in the Quantopian community who's in our diligence process. He's a super smart guy, and he's developed a lot of good strategies, some of which are already in our fund and some of which are, I expect to be in the next round of our fund. So, I'm sort of not picking on him to say that he's bad, for overfitting, but rather to say, anyone can sort of can sort of hit on these problems and they're surmountable. So here, what I'm showing in this table is he's got 4 different strategies that we've been looking at. And when we discovered those, each of them had the smallest number of positions. So in stock market modeling, what I mean here by position size is that strategy might be invested on any given day in 30 different stocks in the market, right? And then what I'm showing is sort of the quality measure is 2 different Sharpe ratios. So Sharpe ratio is just your risk-adjusted returns, your returns over basically your volatility. And I'm showing a total Sharpe ratio. So let's say we've evaluated this strategy over some time range, couple of years. And then on the last column is out of sample Sharpe ratio. So that means since he finished writing the strategy, what has the Sharpe ratio been on the subsequent time period? So if you're familiar with the field, and like classic to overfitting, what you don't want to see is, a big discrepancy between sort of what you model, what sort of quality measure, let's call it, you've modeled, and then you take your model and you try to generalize it on new data, which is what out of sample data is, and you see a big degradation. That can be sort of a warning sign.
Somewhat surprisingly, many of his models have done better out of sample.
Yeah, right? Exactly. So that's the thing, right? You look and you say, just look at the sort of top row of each one, and you can see why we're talking to him, right? So the most classic failure mode is your total Sharpe ratio looks lovely and your out of sample Sharpe ratio looks like noise. So he's not had that problem. Now, it's not a ton of data. Like, I'm not showing you all the details here. So it's not a ton of data. So there's some luck component in, for example, strategy 2, like, is it really a sharp 5 strategy or 4.5 strategy? Like, I'm sure not. But let's say there's probably like 6 months of data in there, and the total Sharpe ratio might be computed over like a 5 or 10 year period. So, but yes, he's not having this like classic simple case failure mode of out of sample, we can immediately see these fall apart. So this is like actually one of the like core problems that Quantopian has to confront, right? Is we have so many strategies to choose from. We can look at a Sharpe ratio or any quality metric we want over some time period that's back tested. Then we have like a limited amount of out of sample data, right? Because we launched our platform 6 years ago. Folks have been writing strategies on the platform ever since. But every few months we unlock new data or a new API feature or something, the newer, cooler, better thing. And we would love to be able to look at strategies which are, sort of newly created on the platform. As you do that, you have less and less out of sample data. Now here I show you, well, gosh, these 4 strategies all look good, both on like an in and out of sample Sharpe ratio basis. So what are you going to do about that? And that's sort of like one of our core problems is, of the ones that we find that look like this, some subset of them are just lucky and are overfit, though we don't see it with this measure. And some subset of them, are actually good. And that is like a very high value problem to solve for us, right? Okay, so what's very cool is that because we have access to both position level data, right? So we're not just blind and looking just at a Sharpe ratio or something you can observe from one time series, but I tell you, oh, guess what? I also know that big fat column of how many positions each strategy is invested in. So what we did with this author, based on sort of other information we had, was we said, well, gosh, we don't love really concentrated portfolios. So if you're holding, 30 or 40 or 50 stocks, that's a concentrated portfolio. We're going to have a lot of capital in each position, and we'd love to see you make more bets. So why is that interesting? So I have a bunch of text over here because I figured maybe we would share these slides with folks. But the idea is there's sort of this fundamental law of active management, which if you're interested and don't have that background, I put the link to sort of the classic textbook on that at the bottom of the page, which says your information ratio should be equal to your information coefficient, which is basically like how well is your signal ranking, times the square root of n, where n is the number of bets. So if you have a good, positive, true information coefficient, you have predictive power, you should get a better and better information ratio, better and better results as you increase the number of bets that you take. And for here, I'll proxy that with just this Sharpe ratio. So you should see improved quality with more bets. And instead, what we saw with this author was, as we said, increase the position count. We, in every single case, saw the strategy's Sharpe ratio decaying. So the concern there is, okay, we're backing out a process which he may have done on the way in of saying, hey, I might look at Quantopian's tradable universe, which might be 1,500 or 2,000 stocks, and I have a strategy that doesn't look all that compelling. Let me think of all these clever ways to winnow down to a small subset of stocks, and it starts looking better and better and better. And now remember that you're over some certain time period and you've really winnowed down. So here what I say is like, this is basically an example of overfitting. And what you want to do to avoid that is say, hey, don't over-optimize your model, sort of saying, oh, look, I found the corner of the world in which this model worked really well in this data, because you're almost sort of tricking yourself in that analogous way to looking at a model that just works well in one small range of time. It's like the other dimension.
Got it.
So this one is like really subtle, and actually, I don't have a sort of positive example in here, but the cool thing is this guy had a different strategy where he looked at a number of different sectors alone, and each one of those had some, modest Sharpe ratio. He wasn't as excited about it, and we said to him, "Hey, those actually, would be compelling if you sort of think you know something about each sector. Why don't you try adding those up?" And so there he was sort of adding a bunch of strategies together that were sort of a mosaic. And so as opposed to just sort of ratcheting out, what part of the distribution he was choosing to invest in, and that strategy he actually saw. The combo had a Sharpe of about 2, whereas the individual components each had a Sharpe of about 0.5. So that's like the counter example. That's like exactly what you want to see. If you're adding components together, you're increasing your number of bets or your sort of number of predictions, and your power is going up. That's a good sign that you've avoided overfitting.
And was that the same signal that he was using across the?
No. So he had he had looked at a bunch of sort of sector specific fundamental ratios. So, think, well, sectors, okay, that's sort of like businesses that, financials, right? Or utilities or, consumer discretionary companies. And what he'd done is sort of looked and said, oh, I think that I can learn a little bit about each of these sectors and I can develop a model that sort of has specific ratios or values that are important to that sector. So he actually had tailored a slightly different strategy to each sector. And when he added those up, it was this mosaic effect, right? Where he wasn't exactly adding predictive signals to the same stock, but he was just tiling everything together and he was just purely taking more bets.
So he would take his utility signals and use them for financial services, say?
No, he didn't. Exactly, did not. So he have his utility model that would just cover, call it 50 stocks. So luckily, it's sort of, there's not a frequency domain problem. So it was a similar enough signal for each sector that you could just basically say, sort of think of it as if utility, look at this ratio, right? If financial, look at this other ratio or whatever, right? So if whatever sector you're in, use a slightly different measure to get at, let's say, I don't remember actually what his strategy was, but you could imagine say let's say earnings quality means different things in different sectors. So you could put that all together.
Got it. Very cool.
So that's probably my coolest example. So it's cool. I think that we took sort of more time with that. The rest of these, I think, hopefully are kind of obvious. So I should say, right, so that's real world examples. This guy's in our diligence process. We have allocated capital to him, not these specific strategies. These are strategies that have also gone through our diligence process. And what I'm showing here is sort of the second most common pitfall. And I think I would rank overfitting and sort of over trading or not appropriately modeling what your costs are going to be in the real world. Those are the two biggest problems in this space. For folks to be aware of. So here what I'm showing is 3 different algos that we have looked at. And in blue is what is my back-tested return over some number of days if I assume low, or I think here we might have assumed 0 cost. And then in orange is what if I ratchet the cost up? Now for each strategy I've ratcheted the cost up by the same amount, okay? And what you can see is, wow, these 3 strategies respond to that sort of error in initial condition assumptions in very different ways, right? So I've built a model, it's doing a thing, and now I say, oh, just kidding. Every time you do your thing, you're penalized, more. And what you can see is, and you can sort of imagine what's happening is, algo B is probably the highest turnover algo. Either that, or it's probably trading stocks that are very illiquid, where maybe it's making not a crazy number of trades, but every time it trades, it's getting heavily, heavily penalized. And so, sort of the TLDR on this one is, if you develop your trading algorithm and you're sort of assuming costs that are not in line with what's actually going to happen to you in the market, you're going to have a hard time coming up with a model that you really understand how it's going to perform. Well, what can you do about that? Obviously, you can sort of spend, infinite time and money in this space trying to model costs perfectly. So usually what people do is they say, hey, let me think about ballpark what I think it costs me to trade, and then let me be conservative. So let me apply, a 50% markup to that, or, whatever. The other thing you can do is say, well, gosh, of course, especially if you're, perhaps a Bayesian, or, you come from a data modeling lens where you sort of say, I don't believe I'll know anything precisely. I believe I'll have some confidence interval. Well, then you can also say, let me look at what my model's outcomes are under different assumptions of cost estimates. So let me say, what if I perturb my cost estimate and make it worse by, 10%, 20%, 30%? Where's that tipping point? How certain do I have to be? And if you look at, algo B, for example, gosh, you'd have to be very certain whether you were on the blue line or the orange line, right? Because that's an extremely different set of outcomes. Mm-hmm. Whereas what you want is somebody like algo C, where you say, geez, do I know if I'm going to live on the blue line or the orange line? No, I don't know. But actually, I'd be fine either way. That's what you're looking for.
And with algo A, you're sort of at least I'm not losing money if I'm on the orange line.
Yeah, exactly. Algo A, is you're well, okay, I'm not losing money. But maybe I'm sort of wasting my time, perhaps. But yes, algo A is not that bad. Algo C would be best. Algo B is exactly what you're trying to avoid. And algo B is a very common outcome when folks, sort of run a back test and don't have a great idea what it's going to cost them, and then go into the real world. Algo B is like very, very, very common, I would say.
Provide like some modules or estimates that kind of
Yes.
folks do back testing
We
with?
do, yeah. So we and we've sort of upgraded as we've gone into the market and come up with what we think are better assumptions. We've sort of, I think, updated and improved our default cost model. So on our platform, if you don't know anything about this and you just go to write an algorithm and you don't even sort of address costs, we default you at what we think the right costs are from our perspective. And right now, I think that's something very simple. It's something like about 5 basis points or something per trade. So it's like a fixed cost. It's not super sophisticated, but we think that's fine and reasonably conservative. It may not be conservative enough in some cases, like very illiquid stocks.
Oh, yeah, I was going to say, doesn't that kind of skew people towards choosing things like illiquid stocks?
Yeah, so what we should have, and we've got something prototyped that hasn't quite made it onto the platform yet, is there's a way to be more sophisticated about that. So we're working on trying to bring a better cost model. What I'd say is the smart thing to do if you're sort of on our platform and really want to understand it is, don't just use our default, go the extra step yourself and look at, oh, hey, what if I change it, from level A to B to C, how sensitive am I to that assumption, right? And I feel like, to me, that tells you a lot more than, am I happy with this one specific path-dependent outcome at this one parameter setting? It's rather like, oh gosh, you'd love to know that, well, hey, I'm really comfortable in a wide range, so that's good to know. If you're very sensitive, then you want to look at, okay, let me look at how fast I'm turning over, and am I holding things that, well, actually, yeah, you can't with our model really know to look at illiquid. So on our platform, we also give you a tradable universe, which I think does a decent job of keeping you out of, very unrealistic low liquidity stocks. But those are the two things, sort of in the real world you would want to look at.
Got it.
So let me sort of jump through the last two quickly so we can have time for questions. This one I sort of build as saying like, oh, hey, there's regime changes or, processes you might be modeling, are not stationary. So this is another one where I think sort of, I think it's too young of a field maybe to call it classical data science, but maybe not. But if you look at sort of where I think machine learning has had a ton of success, in image recognition, for example, my sort of like slightly flippant example is like, a cat always looks like a cat on the internet. But unfortunately in the stock market, what looks like a cat one day can look like a dog the next day, can look like a zebra the day after that. And so this is just sort of one example of a way that people think about regimes in the marketplace. So here what I've done, and I'm referencing actually a blog post that one of the folks on my research team put on the Quantopian blog, if you want to dig into it, just basically looked at, oh, hey, what if you sort of think of dividing time into epochs, where in white are periods where we had sort of low volatility based on some historical average, and green are periods where you had high volatility. And like you might assume, if you're used to dealing with data and time series data in the market, is like, gosh, you've got very sort of clustery behavior where sometimes, especially over a long period from like late 16 through, about February of 18, we were in this time where, if you sort of remember or listen to kind of folks talking about the market, everyone was saying like, wow, just such low volatility. Anyone who trades on, dispersion or volatility in the market is just not making any money. Anyone who's just sitting there holding, the market's just like going up, 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 up with very little volatility. Well, all of a sudden, in February of 18, that changed, and we had, sort of the biggest volatility spike that we had seen in about 3 years. So if you think through, okay, imagine you're sitting there on Quantopian or, your own platform, wherever you are, developing a strategy, and you're really focused on the trailing, 1 or 2 years of data, and there you are, putting the finishing touches on your strategy that you want to trade in January of 08. And you're really focused on how the market has worked and what your strategy has done over the last couple of years, gosh, you're about to be in for a surprise. And this is just one example. You could also think of regimes being, generalized periods where the market is going, up but is volatile, or, bull and bear and high and low volatility are two kind of classical examples people think about. And then the last one, which I sadly ran out of time to come up with a nice picture on.
Just to go back on that one, even if we go back to your picture, even there, I would say you haven't quite you captured some of the spikes in VIX, but probably the biggest one in recent memory, '08, isn't even in there.
Oh yeah, totally. I mean, this is just saying, when we wrote this blog post, we were sort of had this perspective of, we thought of what had happened in the first couple months of this year were really interesting. And so we're looking at this like sort of, 5-year picture. But you're right, if you window this out, and if you talk to, sort of more traditional quants, I mean, what they're interested in, right, is getting, 30, 40, 50 years of historical data to be able to say, hey, what's the full spectrum of stuff that has ever happened? And sure, I don't know what's going to happen in the future, but you want to try to, the goal there would be to say, try to have as much historical data as you can so that your model is going to see sort of every possible scenario that it could know about, which even there, right, I mean, you still don't want to fit on all of that. You want to sort of think about like leaving holdouts, but you're right. Yeah, I mean, this is just sort of still a very recent picture.
And so just presumably, you have models that work really well, let's say in the white areas, but do horribly in the green areas and vice versa.
Exactly. And sometimes that's for like very obvious reasons. So, imagine you go design a strategy that sort of sorts stocks on their volatility, or like it takes an explicit sort of, we don't have to go way into it, but sort of a factor bet on volatility. Well, you can imagine you could really almost tailor a strategy that would exactly do well during the white bars and poorly during the green bars. And so that's one thing. If you know that, you can then say, well, I think I have some other signal that helps tell me when to modulate that. Or you can say, well, I'm going to weight that low enough that I know, I'm going to make money during the white bars and not the green bars, and I'm cool with that. And I'm going to sort of be robust to that. What you don't want is to not know that the strategy you've constructed has that bias. Because if you don't know it, then you may be assuming that it always works. And you may be putting too much confidence on it, and you will potentially be surprised when it's going through periods where it doesn't work.
Got it.
So the last one is sort of like the least sexy, but is just, horrible and pernicious. And I can't stress enough, but I think I can explain it pretty quickly, which is, this idea of like, what did you really know and when did you really know it? So, when you're building any model, you're sort of trusting the data set that you've got is sort of like appropriately tagged. And in the stock market, modeling the stock market land, time is a very important component. And so precisely tagging data that you're telling your model you had with the time that the model can believe that it would know about it is critical. And there are just like a litany of very common examples folks might make when they're coming into the space. These are ones that we do try to handle for folks in the Quantopian platform, but I think they're still like really important to sort of think about. So, one very common example being, let's imagine I gave you like a price series of daily prices. You would be well served to ask me, and I said like build a model off this, right? And predict tomorrow's price or whatever. You would definitely want to ask me, well, gosh, what price is that, right? It's a daily price. Okay, sure. You have to get that price from somewhere. So is that the opening price of that day? Is that the close price of that day? The high price of that day? Probably I wouldn't give you that. Or is that something like a volume weighted average price over the course of that day? So if you just say it's for that day and you sort of truncate the time label and you then build a model that assumes it could sort of trade on that day on that information, you very likely bleeding information from later in the day and assuming you would have had it earlier in the day. And if you've ever done that, it's extremely valuable signal, but unfortunately you can't get your hands on it. So knowing your timestamps down to, sort of at least a minute, and depending on what type of frequency you're modeling, you need to know them more granularly than that. So that's sort of the time, the market data angle. Now, quants use a lot of data beyond market data. So when we say market data, we sort of mean price and volume. Quants also use fundamentals data. And like I mentioned, right at the beginning of the half hour, we're really excited about folks using more and more fundamental data. That's something we're looking for really carefully right now. But there's also a lot of problems if you don't handle knowing when that data was available. So every quarter on some fiscal calendar, companies report all this stuff about themselves, like what their earnings were, right? And how much, what they spent on things, and what they made on things, like at a high level. And they report those that information, and there's sort of a timestamp associated with, oh, this is for this quarter, right? This is, perhaps like ending, December 31st or something. Well, if you build a model that thinks that you had all the December 31st, quarter end filings on January 1st, you're probably about 45 days ahead of when you really would have had them, which is kind of amazing that the world still sort of works so slowly. Yeah, it's like crazy. You'd think like we have all this information right away. But we don't. And so you just want to know, again, okay, for this data set that I have, when you sort of have a row of data, right, and there's a date in it, in Quantland, you really care, well, what is that date? Is that the date the data was generated? Is that sort of the date, the last date that source data was put in? And then when was my knowledge date? And you'd be amazed, such a simple thing can be extremely expensive and painful to make sure you've got sort of handled correctly in your data set.
And is that something that your platform handles though? Like sort of say—
We do, yeah. So we do handle that for data sets that we've integrated. But we also do encourage folks, there's a big wide world of data out there and we've only got so many engineers integrating it. So we do have a API where folks can bring, we call it self-serve, where folks can pipe in their own data. And I think that's compelling and people should be doing it. So, there you would still be taking the responsibility of making sure the dates that, you sort of feed us a file that has date stamps and stock tickers. And so there you'd really be responsible for making sure that, those date stamps are going to sort of match when you go live. You want to have that date stamped data available when your model's expecting it to be available.
So how does that work though in production? Because you can't guarantee that the quant is going to always be updating that signal in real time, right?
So in terms of like, if I license a signal like that, we have not licensed a signal. Actually, we have done one. So yes, if we do something like that and we say we would allow you to bring in your own data set, there's obviously like a bunch of additional diligence and overhead that would be associated with that. So we need to basically evaluate like, well, what's your infrastructure? And the case where we've done it so far, it's from a team of people that were running their own small investment strategy. So they had a production process up and running that they could show us.
Okay. So it's not just like they just tell you what signal it is and you add it to your universe. It's they actually get to keep their signal.
Yeah. Yes. Now, I think going forward, there's a lot of cases where, so I was talking with somebody yesterday and he was like, oh, hey, I'd really like to build a model with short interest data and I have it from Quandl. And I was like, yeah, that's awesome. I don't think we have it in there yet. Let me check, because we do have to have some type of integration with Quandl. But a great example would be like, well, what if the data is available from another like fairly reliable source, right? And what does reliable need to mean? That actually depends a lot on like how frequently your signal might trade. So you might have like a pretty reasonable sort of not crucial SLA on that if it's a signal that you're going to update more like not that frequently. But you could imagine like that we could expand to sort of have reliance on other signal providers. But yeah, like there obviously you sort of have some additional like operational risk. You want to just make sure that you mitigate. Or right, the other thing is, hey, we're working, we've the other piece of Quantopian is we have an enterprise business where we've signed a deal to offer an enterprise version of our software with FactSet, and they have sort of the entire data catalog, and we're working on integrating all of that stuff. And so like, global pricing and fundamentals, for example, but also other alternative data sources. So the other thing that could happen is someone could get a jump and sort of look at a data source that they pipe in themselves, and then great, 3 months later or something, we have now got it integrated from, FactSet or another vendor. That would be almost best case scenario for me, is I want people to be able to really move as fast as they want on their research. But then if they're doing that, they take on this additional responsibility for really understanding the timeliness of their data. But I think that's good hygiene, and it's good for people to be aware of anyway, to be really like careful about that. So, my like, so what should you do for this one is, be careful about checking it, but also same as with market impact or with sort of cost assumptions, like look at what happens if you don't have your data in a timely fashion, and look at how fast your quality of your signal degrades, because then you'll know how critical that component is for you.
I see. So presumably, if, for example, you use the wrong date, you would sort of see a thing where it's valuable up until day 45 and then suddenly becomes very unvaluable. Is that?
Yeah, exactly. For sure. I mean, there's tons of great examples like that. There's a bunch of papers by this guy, Tim Tetlock, that are looking at, I think he calls it like information leakage or something. So not even on 45 days, but let's say you're like at that time where the numbers are going to get reported. And what's hilarious is you can actually see that prices sort of move in advance of the official release by some amount of time, and then they move almost instantaneously, and then they kind of decay. This is this like post earnings announcement drift work, but it's fascinating when you sort of look and can find, well, somebody knows something, a little bit early. I always thought those papers were really interesting.
It's somebody is cheating playing this game.
Yeah, well, information is leaking out somehow a little bit. So those are the ones that I wanted to run through. And then my sort of shameless pitch is just, if you have great ideas, especially if you're looking at fundamental data, you think you've avoided these pitfalls, or that you can figure out how to, we look at everything that goes into our paper trading contest. So please submit it. And then again, I put some resources here. If we can share these slides, folks can kind of click through. I realized as I put the talk together that one of the folks we had come to our quant conference back in 2015 gave like a fantastic and more detailed version of this that's very approachable and easy to understand, called 9 Mistakes Quants Make That Cause Backtests to Lie. And it's excellent. He has it in blog form and in a YouTube talk. So I have links to those here.
Wonderful. And let me pose a few questions to the audience. The first one is, does Quantopian have any infrastructure to support high frequency or ultra high frequency algorithms?
No, it's so we have minute bar pricing for simulation, but the investment strategy that we run, we ourselves have like low latency connection to the market, but the signals that we're looking for to source from the community, really we're looking for stuff that's like a several days to several weeks hold. Now that's, sort of where we think that our competitive advantage is, given sort of where we've decided to make investment. Is
that kind of a function of infrastructure? Like, I'm just thinking, you run 7 algorithms, but you probably have 7 million. And so each one of those has to be back tested. And if you have to back test that to level 2 data, on a microsecond scale, that might be too many computational resources to. I think it's
like, hey, look, one of the cool innovations I think that we did was to put everything in the cloud and make it run in your browser. And sort of when you learn about the high frequency space, like it's not really amenable, to that infrastructure, I don't think, either on the data end, the modeling end, or the execution end. So the way that we run our process is really, if you think about it, sort of like the algos tell us what they want to do, and we go tell the broker that we want to do that. Now, once we've told the broker that we want to do that, that's a very fast process, but we didn't build the system where there's a very fast feedback loop. So the algo doesn't know until about a minute later what happened to its order that it sent out. So we don't have a great way for you to sort of write sort of HFT logic into your algo. It's rather like you write a signal that, is sort of, let's call it, sure, it could be intraday or daily or a little bit slower. And then you're sort of responsible for putting out like the parent order, basically. And then where everything kind of fast would happen would be in like for us in our infrastructure, in the broker's execution algo.
Got it. And when you say it runs in your browser, you are back testing on your servers, right? You're not like trying to do all back testing in a JavaScript on the cloud. Oh
no, but rather like if you're a Quantopian user, like you don't download anything, right? Like you just come, So and then on our side, all our infrastructure is in AWS.
Got it. And then kind of a similar question: how much of the order book data are you giving? Bid-ask spreads, minutely?
We have minute bars right now. We don't have bid-ask spreads right now. Although that's something that I wouldn't say like, oh, we'll never have that, because I think there's a lot of cool ways that you can use that data.
So you're doing mid?
Right now, we give you open, high, low, close, minute bars. And
okay. Got it.
Back to like 02 or 04 or something like that for US. Now, like I said, a good portion of our team is working like crazy to plug in all this international data. So that's actually going to start expanding and cover more markets starting pretty soon.
Got it. And then if we were to go back, what would be a good Sharpe ratio for you, an Outofsample Sharpe?
Yeah, so, I think especially given the way that we're the way that we're working on trying to add some more value with sort of our combination strategy and logic around that, I'd say signals that have a true Outofsample Sharpe of above, 0.5, 0.7, or 1, those are valuable to us in this model. So, we would prefer a more like a wider breadth, like a higher diversity signal with sort of lower turnover and a more modest Sharpe over, what we think might be difficult to achieve, like a very high Sharpe on a really fast turnover. Now, that said, those are both still interesting, but I guess what I encourage is sometimes I sort of will talk to folks and realize, wow, they are setting for themselves like maybe even an unrealistic high expectation. So I think it's good to sort of be realistic. Don't be like, again, tuning to try to get to some perfect Sharpe level. Be looking for a decent Sharpe, but be looking to not be sacrificing on some other dimension that's maybe making your results like less achievable and less realistic.
Oh, okay. So it sounds like robustness is more important than performance.
Absolutely. Like you want positive performance, definitely, and that's non-trivial to achieve. But what you want is like something where you really know what you're going to get. The more you feel like you have that, like that's what we're trying to look for with our tooling.
And then do you have any advice for people who are looking to get started? Let's say maybe you know some Python already, but what kind of statistical modeling approaches should people be using?
Yeah, so I think it depends kind of what you're coming in with. I always think what's good is to like take where your advantage is and try to press on that and like fill in just enough of what you don't have. So I think when folks come in with, some, sort of edge on, data modeling, then, okay, press that advantage, but, go fill in with what's a reasonable economic hypothesis. Okay, so at least my view, and I think our investment strategy, up until now, and I see it continuing in the future, is sort of we do have a predication on wanting to understand the economic rationale of stuff that we put into our portfolio. So I'd say don't forget about that component. I think folks tend to get like really excited, and it's great about the data and the tools and the statistical techniques, and those are all important, and I think you can get an edge there. But it's also really easy to sort of be fooled by randomness or be tuning something that's noisy if you're like looking through all possible parameter space. And it's like, I think, just spending a little bit of time, reading through, whether it's even starting with, financial or markets-based blogs or something, right? Or getting some, just basic finance course knowledge, basic, how do company fundamentals work? Like how do people value stocks, right? Those basics, I think. And if you come from the other side and you have the, financial or quant domain knowledge, then I'd say, sure, make sure you got to learn Python. That's how I think about it, I guess.
Got it. And how do you balance the sort of your commitment to keep people's IP secret and so they own it and you don't know what they're actually doing with the sort of need for them to explain the economic?
Yeah, we have not, like that was something we spent a ton of time talking about like before we licensed our first strategy, and it has not been difficult, actually, I would say. So while we have 7 strategies trading today, I would say like we've certainly had developed relationships with and licensed strategies and worked with, in the dozens of people. And, I'm sure it's a self-selected pool where, the folks that are the most concerned about this just aren't on our platform, perhaps. But when I say economic rationale, like I could say to you, okay, explain to me, does this sort of take advantage broadly of short-term reversal? Or you could say that it does, and I could say, oh, that's interesting because I don't see a lot of exposure to short-term reversal. And you could say, well, that's because I'm doing a bunch of different stuff to tweak it, and maybe I do something sector specific, or maybe I do this or that. Cool, right? Like we're not sort of there to say we think your economic rationale is not detailed enough, or we think it's wrong. So I tend to use that like less as like, we're going to be like the extent to which we can actually sort of prove that to ourselves is low. What we're using to try to convince ourselves that you did have an economic rationale is usually looking at like our own risk decomposition, like, well, what risk factors are you exposed to? And then where we might ask more questions is if, your sort of very high level description is either like at odds at or bears no relation to sort of what risk exposures we see you taking. But so far when we've worked with folks, like it's pretty clear to them that like, we have like 1,000% incentive alignment with the community to attract talent. And so they seem to have developed a good trust around, that we have it really in our best interest to protect their IP. We want them to, be getting paid. We've set up a fee structure with our investors where their fees come out first. And we only take our fees after the author fees. So I think we've been able to convince folks, sort of one at a time over the last couple of years that, we're trustworthy, our incentives are aligned here, and we're not looking to reverse engineer sort of their secret sauce.
Got it. Well, thank you so much, Jess. Really appreciate your coming back for the second time. I think the audience really appreciated it. I see a lot of questions that people still have, and I think this talk has really kind of galvanized interest in sort of data science and Quantopian. So for those of you who've enjoyed this talk and you're thinking, I too would like to make a lot of money back testing quant algorithms, you might want to consider learning more about data and data science. And you can certainly do that at both Quantopian's website and blog, and also at the Data Incubators. And for those of you who just joined us, we run a free fellowship for PhDs and master's students who are looking to make a transition into a data science career. We also offer online courses for working professionals. And in fact, tomorrow is the last day you can sign up for our foundations course, which is one of our more popular ones, kind of teaching the fundamentals of Python and data science. And then, of course, we also offer corporate training and placements, so we help companies hire and train their data scientists. And you can find out more about all of that at thedataincubator.com. And without further ado, I guess we will bid everyone adieu for the evening and see you in a month from now.
Thank you so much, Michael, for having me.
Hey, thanks so much for joining us. Cheers.